Good morning. My name is Henning de Kok, and I'd like to thank you for joining us for this webinar on upcoming amendments to the JSE Listings Requirements and Companies Act, presented by PSG Capital in collaboration with Cliffe Dekker Hofmeyr. The last few years have seen a number of changes to the regulatory landscape for South African corporates, and especially for those listed on the JSE. Some of these changes have already occurred. For example, the streamlining of certain financial reporting requirements by the JSE, while others may take effect soon. These changes range over a wide area. Some are aimed at improving corporate governance through increased transparency, accountability, and disclosure. And here one thinks, for example, of the upcoming changes to remuneration committees introduced by the Companies Act. Other changes flow from the JSE's ongoing drive to simplify its listings requirements, to ensure alignment with other international exchanges, to attract new listings, and to stem the exit of small and mid-cap companies from the bourse. Today's webinar is therefore focused on changes affecting South African companies with a primary listing on the JSE. However, secondary listed companies may also benefit, as they will get additional insight into the JSE regulatory regime in case they consider a change from secondary to primary status. PSG Capital's role is to help clients navigate these changes. We are clients' first port of call should they have regulatory questions or be considering a corporate action. So therefore, before proceeding, perhaps a bit of background to those of you who are not yet PSG Capital clients. PSG Capital is a leading corporate finance house offering the full suite of investment banking and advisory services. Whether you are considering a listing, raising capital, an M&A transaction, or you need to obtain a valuation or fair and reasonable opinion, our team of seasoned professionals will be able to assist. We are one of the biggest sponsors on the JSE with 36 listed clients and are also a Cape Town Stock Exchange issuer agent. All of this is evidenced by our numerous Dealmakers Awards over many years. I'm joined this morning by Monica Griesel, who heads up PSG Capital's sponsor team, as well as Logan Hufke, who has led the charge on JSE workstreams for many of the key transactions undertaken by PSG Capital in recent years. I'm also very pleased to be joined by Rob Smith on the JSE Advisory Committee, who will be providing us with some of his insights. Last, and certainly not least, is Andre de Lange, who will be providing input on the changes to the Companies Act. He is a director at Cliffe Dekker Hofmeyr's corporate and commercial practice. By way of a quick overview, first, Rob will take us through background and an introduction to the JSE market segmentation and simplification projects. Following on this, Monica will provide additional detail on the market segmentation project, which the JSE has launched and which the JSE announced last week will already be taking effect on the 23rd of September. Following on this, Logan will provide detail on the JSE's ongoing simplification project and some of the items that are being considered in this regard. The JSE segment will be closed by a Q&A session. We have already received questions which we'll answer, but should you have any further queries during the course of the presentation, you're very welcome to submit these to us. You can click on the Q&A icon which appears on your screen. A text box will appear. Please type in your query and click send, and we'll endeavor to respond to that. The JSE section will be followed by a Companies Act presentation by Andre, in which he will look at those changes to the Companies Act that are most relevant to listed companies. His section will also be closed off with a Q&A session, so please feel free to submit any additional questions that you may have from a Companies Act perspective as well. So with that, over to you, Rob.
Thank you, Henny. By way of introduction, my name is Robert Smith. I've been in the corporate finance field for approximately 28 years and have also headed up a sponsor team that managed approximately 40 clients in the listed space. We weren't sector specific, and we had clients that had large market caps and small market caps. As a result, the sponsor team and myself clearly had lots of dealings with the JSE and encountered numerous issues relating to the interpretation and the ambiguity in respect of those listings requirements. As you can see from the slides, and I'm not going to go into too much detail, suffice to say that over a period of 2 years, the JSE have reduced the listings requirements from approximately 400 pages to 200 pages. Why has this been done? I'm quite sure with some of you, on this webinar, have been impacted by the listings requirements and the ambiguity relating to corporate actions, financial disclosure, and directors' dealings, etc. I'm also sure that during the process, you were also involved in applying for rulings and waivers as a result of the listings requirements, which at some stages would also impact a transaction that was time reliant. As a result of these various rulings and as a result of these various ruling requests and waivers, and that they were becoming more and more common, the JSE issued practice notes and guidance notes. Unfortunately, there was a mismatch because some of the guidance notes and practice notes were over 10 years old. So it really exacerbated issues when it came to interpreting the listings requirements and also referring to the guidance notes and practice notes. It was also of the view that the JSE was overreaching its jurisdiction by the accreditation of auditors, experts, competent persons, valuators, which exacerbated issues, particularly when it came to corporate financial transactions. From a JSE perspective, they've also come under a lot of fire in respect of delistings. And in respect of delistings, they then decided to do a survey of why delistings were taking place, particularly amongst your mid-cap and small-cap stocks. And the underlying theme from these various engagements with the mid-cap and small-cap stocks was the cost of maintaining a listing together with the interpretation and compliance of the listings requirements. Bearing in mind that with your small-cap type companies, they essentially didn't have a huge back office to assist with the interpretation of listings requirements. You had an FD and a COSEC who were spending an inordinate amount of time on applying the listings requirements, when in actual truth the FD should be more concerned on running the business operations. In my view, what had a serious impact and actually brought to light the issues with the JSE and with them being cumbersome was COVID. During COVID, most of the foreign exchanges acted very quickly to assist their clients by ensuring that they could raise capital without going to shareholders for approval, by giving them waivers when it came to financial disclosure. However, from a JSE perspective, and particularly at the beginning of COVID, it was quite traumatic for some of our clients, particularly when they wanted to raise money, and the only individuals that they could contact at those times were material shareholders. And what they then had to do is develop a hybrid of a general issue of shares for cash and a specific issue of shares for cash, where although the JSE adopted a fast-track process, proved very, very difficult to lock in institutions for a certain length of time. The other issue, you had REITs who had to distribute their 90% of their income. Clearly with COVID and the impact on their businesses, this had a major effect on those REITs. Similarly, when it came to financial disclosure, the JSE virtually adopted that rules are rules, and unfortunately the listed issues must comply. Clearly, there was also a disconnect between FSCA, which is the Financial Services Conduct Authority, to whom which the JSE reports. And these raised the concerns of not only listed entities, but also the practitioners who are trying to advise and steer the listed entities through this difficult part of COVID. Following COVID, the reality was that something had to change. And in all fairness to the JSE, and with the inclusion of members of the advisory committee, they then adopted what they called a simplification and cutting red tape project. Many players were included in these projects to ensure transparency. Third-party service providers were included to assist with the process, and also there was an examination of foreign exchanges and their listings requirements. Once all the comments were received, the advisory committee, together with the JSE, would then go and have an open and honest debate, bearing in mind that although there had to be change, there also had to be a balance that had to be maintained to ensure the integrity of the JSE. All amendments of the proposals were discussed with all role players once again, and it is now the intention of the JSE in the first week of October to release the full set of listings requirements for further consideration, and it is expected that the close-off will be towards the end of November to ensure that these new listings requirements will come into force in the first quarter of 2025. It has also been quite noticeable that there's been a lot of engagement with FSCA, and FSCA is on the same page of the JSE to ensure that the deadlines from October to January 2025 are met. A member of the advisory committee has also been tasked to ensure that all references, definitions, and interpretations of listings requirements make sense. And to this end, the JSE is going to work closely with sponsors to ensure that they raise the concerns of issuers with the JSE. It is not expected that there will be material issues, as by and large they've been addressed in the revised listings requirements, which includes the market segmentation, which relates to the splitting of the JSE. And it is, however, important that sponsors like PSG are proactive in engaging with their clients to ensure that all concerns are addressed, all suggestions are then passed on to the JSE to ensure a smooth transition. I would now like to introduce you to Monica, head of the PSG sponsor, who will go through in more detail with regard to certain amendments to the listings requirements, both that have come into existence and proposed amendments. Thank you.
Thank you, Robert, for giving us some background and insight into the JSE's thinking, specifically around the two projects that myself and Logan will be taking everyone through this morning. So as Robert alluded to, the JSE has been addressing this concept of simplification and cutting red tape for a number of years now. And one such project, as mentioned already, that will be coming into effect at the end of this month. This is the market segmentation project, and considering the webinar is taking place today, it's very well placed in terms of timing to explain to our clients how this may impact them going forward. So what is the market segmentation? Essentially, it is the segmentation of the main board of the JSE into a prime and general segment. The purpose of the segmentation is to support the smaller companies on the JSE and provide them with less onerous requirements in order for them to be able to raise capital more freely while still maintaining investor confidence, as it will still be considered the main board. So practically speaking, how will this segmentation work? So the JSE has indicated that all the current main board entities will default to the prime segment. If a company is eligible to apply to the general segment, they may do so, and the threshold that will be applicable will be the JSE FTSE All-Z. Interestingly, when the JSE announced this proposed segmentation back in April of this year, around 52% of companies on the main board would have been eligible to reclassify into the general segment at that time. We'll discuss briefly the All-Z index, but I just would like to touch on the movement between the two segments. So the JSE has made it very clear that they do not want companies to flip-flop between the two segments, So what they've done is they've put in place a 12-month review process. So by way of an example, if a company is listed on the prime segment and they fall out of the ALSI, they would then need to be out of the ALSI for a period of 12 months before they can apply to move to the general segment. Similarly, if the company is in a general segment, they will need to be, if they fall within the ALSI after a few months of trading, they will need to be in the ALSI for a period of 12 consecutive months before being reclassified to the prime segment. So with this 12-month review process in place, the JSE is now comfortable that there would need to be a significant change in the life of a company in order to move from between the two segments. Then, as mentioned, the threshold between the two segments will be the ALSI index. And as I'm sure most of us know, it's a widely used equity market benchmark in South Africa. This index is reviewed semi-annually in March and September, and there are various eligibility factors that the JSE look at in order to construct the index. Namely, the JSE will look at the market cap of a company, its liquidity and free float. I won't go into the detail of how it is constructed, but essentially the JSE has to tick all three boxes for the company to be included in the index. Then moving on to the reforms that would be applicable to companies if they are listed in the general segment. So these are what the JSE called reforms, but essentially it is the less onerous requirements that will be applicable to these companies. So when looking at Category 1 percentage thresholds, the JSE will bump this up to 50% as opposed to the 30% which will still be applicable to the prime segment. This will give more flexibility for clients or companies listed in the general segment to enter into transactions that have a smaller market cap. Then similarly with respect to Cat 1 transactions, if a listed company has a subsidiary which is also listed and the subsidiary enters into a transaction, the listed holdco won't need to prepare a circular for that transaction. Then when it comes to small related party transactions, the threshold will increase to between 3 and 10%, as opposed to the 0.25% and 5% threshold, which would be applicable to the prime segment. The JSE will do away with all pro forma financial information for transactions on the general segment. They will rather require a detailed narrative in the circular or announcement. There will be certain corporate actions that won't require a fairness opinion, these being your specific issue of shares, your general issue of shares when it comes to options and convertibles, specific repurchases, related and small related party transactions, provided that the agreement relating to the corporate action will be available for inspection and a specific board statement included in the announcement and or circular. Then moving again back to Cat 1 transactions, currently the JSE requires 3 years of historical financial information when it comes to the subject of the disposal and acquisition. The JSE will now drop that to 1 year of historical information. They're not applicable to our current listed clients, but on a new listing, the JSE won't require historical financials for a subject of a Cat 1 transaction of the year of listing and the preceding year. Then there are certain recurring resolutions that most listed entities include in their notice of AGMs. The JSE has done away with certain shareholder approvals, so these would be able to be removed from the notice of AGMs. These specifically being your general authority to issue shares for cash and your general authority to repurchase securities. So for those two corporate actions, no shareholder approval would be applicable or required for companies on the general segment. Then when it comes to your specific authority to repurchase shares, this too will no longer require shareholder approval, subject to not exceeding 20% of your issued share capital in a financial year. However, it is not applicable when there are repurchases from related parties. Interestingly, the JSE has said that there won't be an obligation for companies to release results as long as they release their annual report within 4 months of the financial year end. The definition of material shareholder will increase from the current 10% to 20%, again only applicable to the general segment, And then a pre-listing statement will only be triggered for issues of shares exceeding 100% of your shares in issue over a 3-month period, as opposed to the current 50% threshold. So in conclusion, these are the reforms that the JSE initially proposed and now will be effective for the general segment at the end of this month. But in conclusion, and to give our clients comfort, PSG will be able to advise our clients whether they remain on the prime segment or apply to be reclassified in the general segment. And now I'd like to hand over to my colleague Logan, who will take us through the simplification project.
Thank you, Monica. Good morning, everyone. Rob has already touched on the background and rationale for the JSE simplification project. This morning, I will take you through some of the amendments in a bit more detail. The JSE commenced a staggered consultation process since September 2023, which will run for 18 months, to make the JSE simplification project more palatable and to be able to obtain comments from all stakeholders. The JSE has even gone so far as to create a dedicated portal which can be accessed at the link below, which contains all proposed amendments and key information. As Rob mentioned, we anticipate that the JSE will release a final consolidated simplified version in the coming weeks. So the general changes have been implemented to simplify, as the name suggests. These are largely to remove ambiguity, duplication, to consolidate sections where applicable, and to cut down on repetitive references. We anticipate that once the simplification project is complete, the JSE listings requirements will reduce by almost half, from 400 pages to just over 200 pages. Turning now to the specific sections. First, continuing obligations. Newly appointed directors and company secretaries will now be required to submit their declarations within 7 business days of appointment, which has been brought forward from the 14-day period. Importantly, the integrity information contained in those declarations will also be required to be announced on SENS. Turning to dealings announcements, in the case of options, the JSE has now proposed that the number of options, as well as the class of securities to which those options relate, be announced on SENS. Turning to Section 60, written shareholder resolutions, the JSE has provided clarity that when these resolutions are adopted, although uncommon, the disclosure will need to be similar to that for resolutions passed at general meetings. Now turning to corporate governance. Given the rising importance of corporate governance, the JSE has proposed a standalone section to deal with corporate governance. Some of the proposed amendments are the following. Firstly, retiring of non-executive directors. We often receive questions on these sections. So the JSE has now clarified that the 1/3 retiring must be the longest standing 1/3 of the non-executive directors. In this regard, both the nomination committee and the board will now be able to recommend eligibility for reappointment. The responsibility statement required from the CEO and financial director of the issuer will now be housed in the annual financial statements and no longer the annual report. Now turning to corporate actions, where there are significant amendments proposed. I think we've all been there where an issuer decides to embark on a corporate action and we find ourselves flipping through various sections of the listings requirements. To address this, the JSE is now proposing that Section 6 will be a one-stop shop consolidated section dealing with corporate actions. It will follow the corporate actions listed in alphabetical order with their specific requirements, announcement requirements, contents of the circular, and documents to be submitted to the JSE, all consolidated. Turning then to specific amendments, from a general and specific for general and specific issues of shares for cash and repurchases, the JSE has also recommended significant amendments. Firstly, the reduction of the level of shareholder approval required from 75% to 50%. Then, for general issues of cash to related parties and repurchases of shares from related parties, the JSE has now recommended that we do away with fairness opinions and instead the independent board be required to express an opinion on the fairness. And then, with regard to pro forma financial information, the JSE has recommended that this also be removed and instead a detailed narrative of the impact of the issue or repurchase on the financial statements be included. Turning then to related parties, the JSE has recommended that the definition of a related party be extended to include a management company, not only in the case of a property entity. Then also, a related party transaction will now include any transaction which may benefit a related party. A related party transaction will now also exclude any transaction amounting to exactly 0.25%, not just a transaction which falls below that threshold. The JSE has also recommended that financial assistance to directors in terms of Section 45 of the Companies Act now be included as a related party transaction, given past abuses in this regard. And lastly, the JSE has also recommended that the removal of a fairness opinion for Category 1 related party transactions be implemented, given that there are already sufficient safeguards in place in this regard. And then lastly, looking at the financial information to be disclosed. So the JSE has also proposed that the onerous requirement that historical financial information be disclosed in accordance with the accounting policies of the issuer. Now, the historical financials will need to be presented as is. For Category 1 transactions, the JSE has limited to 2 years as opposed to the 3 years. And lastly, the JSE requires only publication of headline and diluted headline earnings per share as opposed to all the other financial measures. Those may only be required in certain specific instances. From a forecast perspective, the JSE has removed the general and specific differentiation. It will now all be the same, and these requirements will also be the same as as estimates. So thank you very much everyone for your time. I'll now hand over to Henning, who will be moderating the Q&A session of the presentation.
Thank you, Logan, and thank you to everyone who submitted questions, whether before the presentation or during the course of it. We'll be running through these and hoping to respond to all of them. I am conscious of time, so if you have asked a question and we're not able to get around to it, we will contact you directly via email. The first question. Are companies who wish to list on the JSE eligible to go directly onto the general segment? Logan, would you take that one?
Thank you, Henning. Yes, they are. However, at a pre-listing stage, the JSE will consult its indices department to determine the likelihood of the company being included in the ALSI in future, which could impact the segment decision.
Thanks, Logan. Thanks. Okay, next question, perhaps Monica, you could take this one. With loans and other financial assistance to directors now being deemed related party transactions, I assume fairness opinions will be required for such loans and other financial assistance.
So Henning, to answer the question, the answer is yes, but probably not for very long. Through the simplification project, the JSE intends to remove all fairness opinions, save for delistings.
Okay, thanks. The next question, will institutional investor mandates include both the prime and general segment? Robert?
So the initial view from the JSE is that they don't see this being an issue, as as companies on the prime and general are listed on the JSE. However, it's a more of a wait and see approach. When institutions were approached for comments regarding this segmentation, that issue wasn't raised. I think similarly it could apply to corporate financiers as well, who are going to have to be aware of the status of their clients that they're representing, because clearly there's going to be differentiation from the disclosure requirements in respect of the prime and general segments.
Thanks, Robert. And I think in any event, I think some of the same principles that typically apply when institutional investors look at companies from a size perspective, liquidity, etc., will obviously still apply in their investment decision making, whether or not the company is on the general segment or the prime one. Next question, and Logan, this one for you. Companies in the general segment don't require shareholder approval to issue shares for cash up to 20% of their market cap. Will we then be able to issue shares at any price?
No, so the normal discount parameters will apply, being a maximum discount of 10% of the VWAP over 30 business days.
Okay. Okay, the next one was a question submitted beforehand. I have two questions on the replacement of pro forma financial information with a detailed narrative when indicating the impact of a transaction or corporate action on an issuer's financial statements. One, does this replacement apply to all events and not only Cat 1 transactions? And then what would constitute detailed narrative versus what is contained in pro forma financial information?
So Henning, would you like me to take that?
Yes, Monica, if you could. Thanks.
Sure. So regarding question number one, yes, so as we understand it, the detailed narrative will replace all pro forma corporate actions, not specifically Cat 1 transactions. And then regarding question two, when it comes to the detailed narrative, the JSE has indicated that they would like an explanation of how the transaction will be treated from a IFRS perspective. They would need to also understand the impact on debt and cash levels of the company post the transaction, and also understand if there's been any changes to the number of shares in issue.
Thanks, Monica. Next question. In the past, our company had to submit a repurchase program to the JSE via our sponsor when we wanted to purchase or repurchase shares in a closed period under our general authority obtained at the AGM. Will we now be able to repurchase during a closed period without the need to submit the repurchase program to the JSE? Robert, would you mind taking that?
Yeah, sure. And then from a JSE perspective, companies will still have to submit their repurchase programs prior to the closed period, and clearly the parameters surrounding closed period buybacks will still remain in place.
Okay, thanks. Next question. Where the general share repurchases and issues no longer require shareholder approval on the general segment, will current price limits continue to apply? Logan?
Thanks, Henning. Yes, the price limits will still apply. I think that's part of the reason why the approval can fall away.
Quite right. Monica, another question for you. So in relation to the fact that there won't be an obligation to release results and that it's sufficient to release an annual report within 4 months from financial year end. So if a company chooses to voluntarily still release results, can they?
So, yeah, so that change was actually quite an interesting one from a JSE side, but yes, from what we understand, most companies will actually still opt to release results, seeing as those shareholders are used to receiving those results within the 3 months as it stands.
Quite right. Yeah, I think it is important to manage investor expectations, especially if they've become accustomed to it. Next question. Will there be any changes to director dealings and when these need to be announced? Rob?
Thanks, Henny. There have been a few minor tweaks to the disclosure requirements, but by and large, there will be no change from a timing perspective and the content of the announcements that are released via SENS.
Thanks, Rob. And I think while we're on you, would you mind just responding to this one as well? Given these changes, what is the benefit of AltX? I assume this is in relation to the general segment versus AltX.
Yeah. So I think from a JSE process perspective, their main focus was on the main board. And as you can see from their timeline, with them reducing the actual listings requirements and ensuring that they are implemented by the first quarter of 2025, around about January 2025, they're then going to focus on AltX and the need for AltX, but specifically because of the segmentation that they've now introduced. So I would say that is a process that will happen regarding AltX.
Okay. I think the admission requirements, obviously, for a new listing onto AltX obviously differs from the main board, so I think that will probably continue to apply.
Correct.
But this may result in more companies transferring their listing from the AltX to the main board.
Correct.
Thank you, everyone, and thank you to everyone who submitted questions. Andre, I'll hand over to you to take us through the Companies Act amendments.
Thank you, Henning. Good morning, I am Andre de Lange. As Henning said, I'm a director in the corporate commercial department of Cliffe Dekker Hofmeyr. I practice in our Cape Town office. So today I will be dealing with the most recent amendments to the Companies Act. So you might know that on 26 July 2024, the President signed into law 2 Companies Amendment Acts. The first one dealing with some ad hoc changes to the Companies Act, and that is actually what we're going to focus on today, as well as the second Amendment Act dealing with the time periods for actions against directors, as well as the declaration of the directors as delinquents. So although the Act has been signed into law, the operation date has not yet been announced. So it's law, but it's not yet in operation. So we're waiting for the President to declare that or proclaim those dates by notice in the Government Gazette. We are not certain at this point in time exactly when that will happen. What we do know is that regulations will be required to implement some of the changes, so we're still waiting for that. Hopefully, there will be sufficient time given to shareholders and companies to prepare themselves for these changes, and there will be some staggered implementation provisions provided for. Now, the First Amendment Act, it states as its aims to ease doing business, making company law clear, less burdensome. There's some administrative changes, tidying up of things. So to the extent that it's probably an open question as to whether the acts have succeeded in that aim, I think there has definitely been positive changes, but I think there's probably still a lot more that could have been done in respect of the Companies Act. In respect of the remuneration provisions, the aim is really to achieve equity in respect of remuneration between stakeholders, addressing public concerns on high levels of income inequality, and to achieve better disclosure of executive remuneration. So just the format of the presentation, I'm going to deal with those 7 items that we regard the most relevant to companies listed on the JSE. Okay, so firstly, the first one is the amendments to Section 45 of the Companies Act. As you would know, in terms of Section 45, a company may grant financial assistance to its related or interrelated companies or corporation only if it's authorized thereto by a special resolution of its shareholders. It also requires a board resolution, as well as the application of a solvency and liquidity test, and then notice has to be given to shareholders either at the time of making of the financial assistance, the giving of it, or in the annual financial statements. Now, this is a very burdensome provision, especially in companies, large companies with a lot of group companies. On a daily basis, there are a number of instances of financial assistance, and then to require a board resolution for each of them, as well as the application of the solvency and liquidity test, is very burdensome. So what has happened is that the Act has now been amended to now provide for if a holding company provides financial assistance to a subsidiary of the holding company, then Section 45 no longer have to be applied. So this is definitely a step in the right direction. Unfortunately, it probably doesn't go far enough. Financial assistance by subsidiaries to co-subsidiaries and from subsidiary to the holding company will still require a special resolution in terms of Section 45. And then it's also important to note what is the definition of a subsidiary in terms of our Companies Act. It only refers to a South African subsidiary. So in a group structure where you might have foreign subsidiaries, the holding company will still require Section 45 resolution to provide financial assistance to that foreign subsidiary. That foreign subsidiary would be regarded as a related corporation. So I think it's important that companies will have to look at their group structure to just ascertain whether they can do away with the Section 45 for its holding company or whether they still require that resolution. So the second aspect is in respect of employee share schemes. Currently, companies would be exempted from the provisions of Section 44, 45, 41 and the public offer requirements if it provides financial assistance or issues shares or offers shares to an employee share scheme as defined in Section 95. Now, Section 95 is very specific when it talks about what type of scheme we are talking about, and it talks about a scheme in terms of which shares are issued by the company to that scheme or options are granted to the scheme by the company. So this, as you probably would know, there are some schemes that work in a different way, that's got a different mechanism, and where the scheme actually goes into the market and acquires shares for purposes of the scheme. Now, these types of schemes will not fall within this these exemptions in terms of Section 44, 45 and 41. Fortunately, the Act has now been amended to actually now also incorporate those types of schemes. So an employee share scheme which purchases shares on the market in the company would now also fall within these exemptions. Okay, so then just looking at the share buyback provisions, I think these are quite important changes that were made. So as you would know, currently, presently there's no shareholder approval requirements in terms of the Companies Act for share buybacks other than under Section 48(8). A company must comply with the requirements of distribution, so a solvency liquidity test has to be complied with. And obviously with listed issuers is different. So listed issuers have to follow the provisions of the listings requirements, and they would require shareholder approval. I mean, there is some changes that I think Monica, changes in the offering that Monica dealt with earlier. Okay, so the question is, what is the requirement then of the current requirement of Section 48(8). So firstly, 48(8)(a) provides that repurchases from directors, prescribed officers and their related persons required approval by special resolution. And then 48(8)(b), the more controversial one, requires that repurchases of more than 5% of the shares in issue in terms of a transaction or integrated series of transactions would be subject to the requirements of Section 114 and 115 of the Companies Act. And these provisions have caused a lot of headaches for lawyers and corporate financiers. Because what exactly does it mean to be subject to the requirements of Section 114 and 115? I think Section 115 is quite clear. You need a special resolution and probably the appraisal rights would apply. But Section 114 reference is not that clear. 114 deals with schemes of arrangements, and the question is whether this repurchase would now be regarded as a scheme of arrangement. And if it is, then it would, for regulated companies, would be subject to the takeover regulations. So this was always a bit of a grey area in our law, and there's quite uncertainty. And then a recent case, in the capital appreciation case, the High Court said that it was not a scheme, but merely subject to the procedural requirements of a scheme of Section 114. But the Supreme Court of Appeal muddied the waters and referred to it as a fundamental transaction, which actually put you back into the scheme of arrangement. Now, fortunately, in terms of the Amendment Act, there has now been changes to the Section 48(8)(8). And I think the most important one is that they've done away with this more than 5% share repurchase being subject to Section 114 and 115. So that is now off the table. Now, in terms of 48(8), you would require a special resolution of shareholders in terms of the Companies Act if the shares are acquired from directors, prescribed officers, person related to directors. So that is similar to the past Section 48(8)(a). And also then if it entails the acquisition of shares in the company other than the following two. Firstly, a pro rata offer made by the company to all shareholders of a particular class, that you won't need a special resolution for that, or transactions effected on a recognized stock exchange. So that is where I think the simplification process, etc., becomes relevant for companies listed on an exchange. Okay, so ultimately I think you then end up with a scenario, and it's actually, in a sense, a bit more onerous than the present scenario, is now all share repurchases will require shareholder approval by special resolution unless they are a pro rata office or via a securities exchange. So in respect of unlisted companies, we probably would advise clients to start thinking of how they're going to comply with these requirements, and probably they can look at including a general authority in their AGMs notices within certain parameters. And this is actually something that clients can start doing now already. If they have an annual general meeting coming up, they can probably put a resolution like that into their pact, as it will probably not hurt, and they can make it subject to the Amendment Act coming into force. Okay, so then I think I'm going to just deal with the expansion of the right to inspect company documents by members of the public. Currently, Section 26 provides that members of the public may inspect or copy the securities register or the register of directors. The amendment to Section 26 now provides that you can inspect and you can copy, but also now the MOI of the company, as well as the disclosure of beneficial interest. That register the members of the public can now have access to directly from the company. And then also importantly, any member of the public has a right to inspect the annual financial statements of a company, except, and this is of all companies except for private, non-profit or personal liability companies, which prepares the annual financial statement internally and has a public interest score of less than 100, or where such company has its annual financial statements independently prepared and has a public interest score of less than 350. So the aim of these amendments are really to achieve greater transparency and corporate responsibility to the public at large. I think it is probably quite problematic for the larger private companies. These companies will no longer be so private, and information, especially the annual financial statements, will now be available to everyone, including their competitors, creditors, labor unions. Okay, so then going to the Social and Ethics Committee provisions, I think the important change is for public and state-owned companies. They will now in future need to appoint their members of the Social and Ethics Committee at their AGMs. So it's quite similar to the Audit and Risk Committee members being appointed at the AGM. And also the Social and Ethics Committee will have to present their report at the AGM. I think this is probably not such an onerous provision, because if you think about it, that currently annual financial statement has to be presented at the AGM, and there's no PowerPoint presentation normally of the annual financial statements. It would be included in your annual report, and people will be able to ask questions at the annual general meeting. Then regarding the exemptions from the requirement to appoint the Social and Ethics Committee, a company can now, there was just one amendment, the company can now request the tribunal for exemption if the company has a formal mechanism that performs the duties of the Social and Ethics Committee. It's no longer a requirement that this mechanism must be required in terms of legislation. So often companies in a group structure had some mechanism that was very similar to Social and Ethics Committee, but that was not required in terms of some law, and you could then not apply for this exemption, but you can now as a result of this change. I think that is probably still very the same. And then what will now happen is that the minister may prescribe minimum qualifications, skills and expertise requirements for members of the Social and Ethics Committee. So we were waiting those regulations. This is quite similar to the Audit and Risk Committee. Then the composition of the Social and Ethics Committee, as in the past, a minimum of 3 members. For public and state-owned companies, the majority of the people should be non-executive directors. Unfortunately, the Act doesn't say who the other people should be, and it should probably be directors or prescribed officers. Then in respect of other companies, this is private and non-profit companies, the members should be directors or prescribed officers. At least one of them should be a non-executive director. This may be a problem for a private company, which some private companies do not have non-execs, but that will have to be addressed. Okay, then I think the important thing is that the minister will also prescribe the format of this report that will be required at AGMs for the Social and Ethics Committee report. And I think that's a good change, because I think often companies are a bit in the dark exactly how the reporting in respect of the Social and Ethics Committee would be, and now the guidance will be given in the regulation. Okay, then lastly, I would just like to deal with the new remuneration provisions in the Companies Act. So I think it's important. I think you all know globally there's a focus on remuneration in companies. There's been evolving regulations. So initially there was just a disclosure requirement, then it became a non-binding advisory vote, and now countries are moving to binding votes on remuneration. In South Africa, King 4 in 2016 came with the recommendation of the preparation of a remuneration policy and implementation report, and that these had to be approved at the AGM by non-binding advisory votes. If more than 25% of people voted against it, then you had to consult the dissenters and then report back how you consulted. The JSE listings requirements then adopted King's recommendation and made it compulsory for listed companies to comply with the provisions of King in that regard. Now, for the first time, the Amendment Act introduced enhanced remuneration provisions in the Companies Act. And very importantly, these only apply to public and state-owned companies. So it doesn't apply to private companies, non-profits, etc. Now, what is the requirements in terms of the Companies Act? Firstly, companies have to prepare a remuneration remuneration policy. And that policy has to be, every 3 years, has to be submitted to the shareholders for approval by an ordinary resolution. So it's a 50% plus 1. It is not clear what the contents of this policy will be. Hopefully there will be some guidance in regulations, or otherwise people will probably follow the King recommendation in respect of that. If you cannot implement the policy if you haven't received approval of the policy. That's very important. Then secondly, you need to prepare a remuneration report consisting of a background statement, copy of remuneration policy, as well as the implementation report. And the Act is quite specific as to what should be in this implementation report. It says it should detail the total remuneration of each director and prescribed officer. And the Act contains a definition of total remuneration, which is quite an expansive definition. Then you have to provide the total remuneration of the highest earner as well as the lowest earner, the average and median midpoint remuneration of all employees, the remuneration gap reflecting the ratio between total remuneration of the top 5% and bottom 5% earners. And this report will have to be approved by the board and presented to shareholders for approval at each AGM. So this is an annual approval that you have to obtain. So the question is, what happens if you don't get approval for the policy or the report? So if you don't get approval for the policy, as I said, you can't implement it, and it must be presented at the next AGM or special shareholders meeting called to approve the policy. If the remuneration report is not approved, the remuneration committee must explain how the concerns were dealt with at the next AGM. And importantly, the non-executive directors serving on the remuneration committee must stand for re-election as members of that committee at the AGM, at that AGM where the explanation was given. This is quite an interesting provision because, as you would know, the remuneration committee is not, they're not appointed by, the members aren't appointed by shareholders. But now, in terms of this requirement, they will have to step down and be re-elected by shareholders at the AGM. Then if the report is for a second time not approved by the shareholders, and remember it is a 50% plus one approval, so it's an ordinary resolution approval, the non-executive directors must stand for re-election as directors at that AGM. And they may not serve on the remuneration committee for a period of 2 years thereafter. Now, this is also an interesting one, and practically it will be interesting to know how you're going to deal with it, because at the time when you give notice of your AGM, you will not know whether your shareholders will approve it or not, so you will have to include a conditional resolution, conditional on the remuneration report not being approved, and then you will have to re-elect the members of the remuneration committee that are directors, re-elect them as directors. The JSE listings requirements will have to be amended to align itself with the provisions of the Act, and we expect that would follow soon. Okay, so then the question is how, at this point in time, how do companies prepare themselves for the implementation of the Acts? I think firstly it's important for companies to have a look at their MOIs. There might be some of the current wording of the Act that has now been amended, that has been hard-coded into your MOI. And in those instances you'll have to amend your MOI to ensure that you now no longer have to comply with the more onerous provisions that will now be hard-coded into your MOI. For instance, the share buyback provision. Often companies would have the provisions of Section 48(8)(b) hard-coded into their MOI. And they probably would still have to comply with it if it's in their MOI, even though it no longer needs to be complied with as a result of these amendments to the Act. Then I think in respect of Section 45, people should start looking at their group structure, considering whether there are non-foreign, there are foreign subsidiaries, and to get a feel for whether they would ultimately still need the Section 45 resolution at a holding company level. Then I think regarding share buybacks, for unlisted companies, people can start considering this general authority to buy back shares that they might want to pass at the AGMs for unlisted companies. I think the Social and Ethics Committee, the people should start looking at the future composition of these committees, and you may need some changes made to your board compositions. Consider the manner in which these committees, these people will have to be appointed in future. Also start considering the Social and Ethics Committee report and the fact that it will have to be presented. Then, in respect of remuneration policy and remuneration report, I think companies should start considering these documents, especially the remuneration report and the matters that have to be reported on. So I think companies should start thinking of how they're going to do that reporting. And I also think that just start considering the new approval requirements for these documents. And then, so this is the end of my presentation, and now we can go to the question and answer session, which Henning will moderate. Thank you.
Andre, thank you very much for that. I see we've received 3 questions. The first one, does the new Section 45 exemption for holding companies to provide financial assistance to subsidiaries only apply to wholly owned subsidiaries?
No, fortunately, it actually applies to any subsidiary. So even a 50 plus 1% subsidiary would be able to would fall within the exemption.
Okay, that's good to know. Otherwise, the scope would have been very narrow indeed.
That's right.
Next question. Regarding the Social and Ethics Committee report that should now be covered at a listed company's AGM, will it need to be passed as a resolution?
Fortunately not. So it would just, similar to the annual financial statement actually, that you actually only need to present to your shareholders, that it would be the same thing. So you don't need to pass it.
Okay. And then the final question, when will the Companies Act changes come into effect? $1 million question.
That is a $1 million question. So as I said in the beginning, that I think it's important that we do require regulations to be made. So there might be a process where there will be draft regulations, they will publish that for comments, and only after that, I think we'll probably get into a space where it can become law. So, and then obviously we hopefully, especially if you think about the remuneration provisions, if you think that you cannot remunerate if your policy is not approved, so definitely you need some leeway or some process in which to get a remuneration policy approved before those provisions become applicable.
Quite right. And I think also just to align one's MOI, for example, with the new changes, as you've said in your presentation, if there are any hard-coded requirements in there that no longer apply, it would be good for companies to be able to address that prior to the introduction of the Act.
Absolutely, and I think probably in future it might be good not to be as specific in your MOI, because just to anticipate future changes as well.
I think we've seen in constitutional documents in certain other jurisdictions where it's less hard-coded. So when there's legislative change, that is automatically pulled through for these companies. So perhaps something to consider, as you say.
Yes.
So on that note, I'd like to thank today's presenters, as well as everyone who dialed in and participated by posing questions. Thank you very much. If you have any further questions, please feel free to reach out to ourselves or to Andre to discuss these. And have a great day further. Thank you.